Hi everyone, Jeff Yastine here, and welcome back to Market Insight for Monday, February 6th. And I'm joined, as always, by my friend and colleague and fellow editor, Ian King, editor of Automatic Fortune. So Ian, welcome back. It's always great to be talking to you.
Always great to see you, Jeff, virtually at least.
And by the way, for everybody, I just want to make sure I put this out there. Make sure to subscribe to our Market Insight YouTube channel and to follow Ian and myself and all of us here at Banyan Hill, and to follow us on social media. So just want to make sure I put that out there. We can always use more subscribers, more input from you in the comments column as well. So make sure it's a two-way channel. We love that kind of communication. So Ian, I thought we'd talk about Tesla, briefly about Bitcoin, and then China and the coronavirus, and what it all means. So let's talk about Tesla. I mean, Tesla had an historic week last week. It popped hugely higher, stepped back a little bit. There were some rallies late in the week. Do you think that this is it for Tesla, or is there still more to come? Because you've been so correct on saying, hey, get into Tesla for such a long time here.
Yeah, Tesla has been, what a week the stock has had, it just reminds me of .com, but for our viewers that didn't participate in .com was like Tesla times 50. There were stocks like Tesla everywhere you looked. But I think really the story has been that they've outperformed expectations. And this stock really all along was going to be a binary event. It was either going to go to zero or they needed to raise capital early last year, or it probably somewhere in the thousands if the bullish forecast happened to be true. But the one thing I'd note is one of the reasons we bought Tesla last August in the Automatic Fortunes portfolio is the level of short interest was about 25%. And we look back historically, when short interest got that high, the risk reward for owning shares was actually better than not. And, right now after this rally, you've seen short interest come down. I think it's around the 10 to 15% range right now. But, there's a couple other things you have to consider. Retail investors really have just started waking up to this stock, and it's bringing in a new type of investor, maybe, a tourist type of investor that doesn't really buy stocks and not interested in the stock market, but sees Tesla going up 20 or 30% a day, and they just want to get involved any way they can. So I think that we've left reality in a sense right now, and hard to do that.
I was going to just step in on you for a second, since we were talking about reality. I mean, one thing I've been impressed by Tesla, and you and I talked about this, I think, last week here on Market Insight, in that they're starting to report profitable quarters. They're not, you can't write a headline and say they're money losing anymore. But the thing, I haven't drilled down into it. I don't follow the stock the way you do. Where are their profits coming from? Is Tesla's business, in terms of the cars that they sell, really picking up that much? Or what else is happening in the background here fundamentally that's allowing this more profitable version of Tesla to come forward? Because that's what I feel like is ultimately driving the stock. And if it's going to sustain itself, it's got to be profits. And it does seem to be getting there. So just where is it coming from? Where's the increase in business coming from?
Really interesting. Model 3s have outperformed sales expectations. They launched that new Gigafactory in Shanghai late last year. The thing with the Shanghai Gigafactory is actually shut down now because of the coronavirus. We're going to talk about that later. But one thing that has really perplexed analysts, especially ones that cover the automotive industry, is that Tesla's margins are actually improving. And this comes down to a few reasons. Number one, the cost of batteries continue to get cheaper. Okay, so a lithium ion battery that you put in an electric vehicle, the cost of producing one has dropped 90% over the last decade. And that trend will continue to go lower. The other thing is Tesla has software that they sell that, there's zero marginal cost for software. So you want a car that drives autonomously, you pay $40,000 for the Model 3. But if you want the software that keeps you in your lane and does the automatic braking and acceleration, that's another $5,000. And for Tesla to produce the software, it's a zero marginal cost business. And it's not in automotive. you don't have zero marginal cost business, right? You have to produce an engine or a wheel or a brake part, and it costs something to produce. So the model for Tesla is kind of changing if you think about it that way. It's more of a software on wheels than it is an actually mechanical thing.
That's fascinating, because then that increases cash flow. And as you said, the company's expenditures aren't having to go up, which is always the big problem with any automotive manufacturer is, you want to build a new car, you have to retool a whole factory and all that. All right, that's cool. So Tesla, it's not over yet. That's your key point here.
Well, George Soros always says when he sees a bubble, he rushes in and buys. And, I think that we saw the first move up, and a lot of people who were buyers between 900 and 1,000 sold when it went lower. And then more people are coming in because they saw the signal that other people were making money in it. And this just turns into a classic mania. I don't know where this thing is going to stop. I've seen some forecasts on Wall Street. I don't know if you saw this Ron Barron piece, but he thinks of this as being a mobility on demand service, right, with robo-taxis by the next decade. And his forecast is that Tesla could be earning $1 trillion a year, basically just moving people and goods around the world. My thinking is that Tesla is going to be a part of our mobility future. The other issue is, you've got Uber, you've got Google's Waymo, and you have GM Cruise that are also competing in the self-driving space. So I don't think this is a winner-take-all move, and I think you can invest in all those companies that I named and participate in their growing revenues in the next decade.
Gotcha. All right, I promise we talk about Bitcoin. It's closing in at around 10,000 or so. It had a great move through all of last year, and after really kind of being written off by so many people after the initial sort of parabolic move, and what was that, on into 2018, I guess, correct?
2017 was the mania.
So you're the Bitcoin expert. Is there more to it, and what's going to drive it from 10,000 to 15,000, 20,000, et cetera?
This has been like the most underloved rally of all time. Bitcoin was up 85% last year, like you said. It's up another 35% this year. So far this year, what we've seen is that the market goes up, Bitcoin goes up. The market goes down, Bitcoin goes up. So it goes up gradually every day. We've neared in on 10,000, which is a kind of a psychological point. But you also had one of the Fed governors the other day saying that they're exploring the use of digital ledger technology, which is basically the platform or the blockchain, to underwrite a virtual dollar. So they'd make a cryptocurrency that's like the dollar that you can use or exchange peer-to-peer without needing a bank. Kind of interesting that the Fed's saying they're going to basically disrupt the whole banking system by making dollars that the banks don't have control over. And so in response to that, one other thing is that Visa actually engaged and has invested a little bit in this group called Lightning Labs, which makes a technology that allows you to instantly transfer Bitcoin. Because one of the big issues with the use of Bitcoin is to confirm your transaction. Let's say if you want to go buy coffee with Bitcoin, it could take 10 minutes for you to pay. You're not going to sit there drinking your latte until it pays. But what this Lightning Network does is it makes it useful in day-to-day transactions. And I think that's really bullish for the adoption and bullish for the use of Bitcoin. And, really kind of what we've been looking to happen since the mania in 2017. Now it's just finally occurring, and not many people are paying attention to it. So I think it's going to be a good year for the crypto space, and something that our viewers should be watching.
Yeah, I agree. I'm not the Bitcoin expert like you are, but back about a year ago, I wrote a piece, a special report for my subscribers. It was called the Better Than Bitcoin Special Report. And the idea was not so much buying these cryptocurrencies, but looking at investing in companies that are heavily into the cryptocurrency and blockchain technology space, since that underlies all this. And it's fascinating to see it all coming to fruition now, especially with this announcement, like you said, when somebody associated with the Federal Reserve says that they're looking into a cryptocurrency version of the dollar, a blockchain-based dollar version of type of software. That kind of thing speaks to a lot of credibility for anybody else out there who doesn't believe that cryptocurrencies and blockchain are more than a fad, which they obviously are not. We've left that in the distance a long time ago. Let's talk about China and the coronavirus now, because last week, and I think this coronavirus thing, kind of blew the market. People were just running in fear and panic away from the U.S. stock market. And then now, our own stock market is off to new all-time highs, yet the coronavirus situation has not abated. And it's just, it goes to what we talk about. You can't always trust what the gut is and go with that, because quite often the market and your own stocks will confound you. And this is what we've been telling people for the last 2 weeks. And here we are, the stock market's at new all-time highs.
Yeah, and kudos to you, Jeff, because I remember about a month ago, you said that we were expecting a 3 to 5% pullback or something like that. The market pulled back 3.5% in the last few weeks. And, the problem is, like, with these pullbacks and volatility is, like, it never doesn't come on no news, right? So there's always something out there, the reason why the market pulls back, especially in these strong bull markets. And it just so happened that the coronavirus, was this possible pandemic that was going to kill us all. That's what it took to bring this market down 3.5%. But I think the problem, like, as investors see, is that when that pullback happens, most investors are sellers. The majority, the reason why the pullback's happening is everyone has suddenly changed their viewpoint on the market. And so that's what makes them really tricky to buy, because you had to think that, okay, I'm going to buy the market down 3.5%. It might go down 10% though, but who knows? But the best thing really to do is just scale in as the market drops. If you're dollar cost averaging in stocks every month, if it drops 5%, then raise your dollar cost average a little bit. If the market drops 10%, raise your monthly dollar cost average. And I think that over time, you will outperform, everyone else, and also the indexes, if you think of it that way. And that allows you to buy pullbacks in a way that can be sustained by doing this dollar cost averaging. No,
you're absolutely right. And, my message to my subscribers and what I would tell anybody watching us right now is, we talk about the market, the S&P 500, well, that's 500 companies. Not all 500 of those companies are going to be, some are going to be falling more, some are going to be falling less, and a few are going to be going up. And the key here is to focus on your individual stocks. And of course, if you're out there chasing the latest and greatest and the market really falls apart, you're going to get hurt the worst. But those pullbacks, those corrections are great times to be looking at, these dividend paying type stocks, especially. And, I have some, you have some in your model portfolio. I do as well. And those corrections are great times to buy, because you know what, even if the stock falls 10%, presuming you're in it for a longer term and more than just a trade for a few weeks or a few months, if it's paying a 2 or 3% dividend and then it rallies back, another 5 or 6%, or hopefully a lot higher, you're doing great. And meanwhile, you're getting paid to wait. And that's the key to building longer term wealth as well. What do you see? Last question here for you, Ian. What do you see for the market? Again, do you think we can keep going higher here?
Yeah, I think one of the big drivers this year is going to be the fact that effectively China has been shut down for a couple of weeks now. And I've read some economists saying that that's going to cut about 0.5% off their growth. Economists were expecting Chinese growth to be 6%, now at 5.5%. And you have to believe that the Chinese government is going to do everything possible to stimulate their economy after they get past this episode, right? So that's good for Chinese growth. Chinese growth, obviously, good for the world. Then you look at the United States, we've got an election coming up this year. The market typically rallies during an election year. There is going to be, the Fed is not going to raise rates. That's probably completely out of the question. And we heard talk actually at the State of the Union about, and one thing that both sides applauded was a fiscal stimulus or an infrastructure plan, something that we've been talking about for 3 to 4 years now. And if this comes to fruition, there are a lot of domestically based infrastructure stocks and, companies that create cement and railroad stocks that are really going to take off this year, I think, if we can get a bipartisan infrastructure plan done in 2000.
Yeah, absolutely. And the last word for me on China is, you talk about the China and supporting its economy. We've seen that already. I think we saw 70 or 75 billion in commitments from the People's Bank of China, their version of the Federal Reserve, to stimulate their economy through this episode with the coronavirus. And I think it's also forcing them to sort of do more work on the trade side, and we saw that as well. I think it was also, they've announced that they're halving tariffs on, I think, 75 billion worth of U.S. imports, something along those lines. And all that, I think, also bodes well for the future of the market here. Just, you have to be a selective buyer, and I think not chase things, and understand where you're going with your money. I presume you would agree.
Oh, completely agree. And I think you just hit the nail right on the head right there. I guess that's the end of our market insights video, Jeff.
Yeah, absolutely. I think that's a good place to wrap things up. So, Ian, I appreciate you coming on, and I was chatting once again for the week. And for all of you, remember to watch us again for next Monday on this Market Insight. For all of us here, appreciate you watching. Thanks.